Welcome back, dear students and scholars. In this lesson, we begin ASC 325, and our focus is other investments and life settlement contracts. This is one of those areas where US GAAP says not every investment fits neatly into debt securities, securities, or equity method investments. So, today we will learn where ASC 325 fits, how insurance contracts are handled, and how the investment method and fair value method create very different income timing. ASC 325 exists because investment accounting is not one single box. Debt securities go to ASC 320, equity securities go to ASC 321, and equity method investments go to ASC 323. But some arrangements still do not fit those main categories. That is where ASC 325 steps in. Think of it as the specialized room in the accounting building, not the storage room, dear students and scholars, but the room where special investment arrangements get proper rules. Here is our learning path for this video. First, we locate ASC 325 within the broader investment standards. Then we move into ASC 325 30, which deals with insurance contract investments. After that, we define life settlement contracts, compare the investment method and the fair value method, and finally apply the rules through practice. The goal is simple. By the end, you should know not only what the rule says, but where the income goes and when it appears. This map is important because many errors happen before the calculation even starts. If the investment is a debt security, ASC 320 may control. If it is an equity security, ASC 321 may apply. If there is significant influence, ASC 323 becomes relevant. ASC 325 handles other investment arrangements, including insurance contract investments and beneficial interests in securitized assets. And ASC 326 comes later when credit losses are involved. So the first exam skill is not calculation, it is routing. ASC 325 has three subtopics. ASC 325 10 is mainly the overall entry point. So it points you toward the operative guidance but does not carry the main recognition and measurement work. ASC 325 30 handles insurance contract investments, including life settlement contracts, and that is our focus in this video. ASC 325 40 deals with beneficial interests in securitized financial assets, which we will cover in the next video. Use the memory line. 325 10 points, 325 30 insures, and 325 40 securitizes. Now we narrow the scope. ASC 325 30 applies when an entity purchases life insurance and is the owner or beneficiary, or when it acquires a life settlement contract as an investor. The key idea is the investor role. If the entity is holding the policy for investment economics and carries the risks and rewards, this subtopic becomes relevant. But life insurance held by pension or retirement plans is not here because that goes to ASC 960. So do not drag every insurance policy into ASC 325 30. Scope discipline saves a lot of accounting headache. Before we measure anything, we need a few terms. Cash surrender value is the amount the policyholder could receive if the policy is surrendered before maturity or before the death of the insured. Policy account balance is the amount held by the insurance company on behalf of the policyholder before relevant deductions. A surrender charge is a contractual fee that reduces what is actually received if the policy is surrendered early. The slide also gives a very important reminder. Legal labels can vary, but US GAAP follows economic substance. In accounting, the label is useful, but the economics gets the final vote. A life settlement contract is a special kind of transaction. The original policy owner transfers the interest in a life insurance policy to an investor. The investor pays more than the current cash surrender value but less than the face value of the policy. Then the investor keeps the policy active by paying future premiums and receives the face value when the insured dies. The investor generally does not have an insurable interest, so the accounting focus is not insurance protection for the investor. The focus is cost recovery, fair value, and gain timing. Demutualization is another item inside ASC 325 30. When a mutual insurance company converts into a stock company, policyholders with membership interests may receive shares. The receiving entity measures the stock received at fair value on the date of receipt. If the carrying amount of the membership interest given up is zero and stock worth $42,000 is received, the gain is $42,000. That gain goes to income from continuing operations, not OCI. The message is clean: measure the stock at fair value and recognize the exchange economics in income. When an entity acquires a life settlement contract, it must elect either the investment method or the fair value method. This election is irrevocable. That means it is not something management changes later because the income pattern becomes uncomfortable. Accounting elections are not a wardrobe selection where we try a new outfit each quarter. Under the investment method, purchase price, direct external costs, and later premiums are capitalized, and gain waits until settlement. Under the fair value method, the investment is remeasured every reporting period, and fair value changes flow through current period net income. Under the investment method, the contract behaves like a cost accumulation asset. At acquisition, the investor records the transaction price plus direct external costs. During the holding period, the investor capitalizes the premiums and qualifying direct costs needed to keep the policy in force. Before the death of the insured, no gain is recognized. Then, when settlement occurs, policy proceeds minus carrying amount equals the gain recognized in income. So the investment method is backloaded. The asset grows, but the income waits for the settlement event. The fair value method works very differently. The investment starts at transaction price, but after acquisition, it is remeasured to fair value at each reporting date. Increases and decreases in fair value are reported in current period net income. Premium payments and policy proceeds are reported in the same income line as fair value changes, giving consistent presentation. So instead of waiting until settlement, the fair value method reflects changes in value during the holding period. This is why method election matters so much. The same contract can produce a very different income pattern. This comparison slide gives the exam ready contrast. Under the investment method, the initial carrying amount includes transaction price plus direct external costs. Premiums are capitalized and gain is recognized only when the insured dies and proceeds are received. Under the fair value method, the investment starts at transaction price only, premiums are reported with fair value changes, and income is recognized each reporting period as fair value changes occur. In simple terms, the investment method gives you a lumpy backloaded result, while the fair value method spreads the income effect across reporting periods. Now let us apply the investment method using Commerce Harbor Fund. In 2026, the fund purchases a life settlement contract for $120,000. It pays $6,000 of direct external costs. It also pays annual premiums of $18,000 in 2026 and $18,000 again in 2027. Then, in 2028, it receives policy proceeds of $240,000. Our task is to compute the carrying amount before settlement and the gain recognized in 2028. Under the investment method, all qualifying costs are capitalized. We start with the purchase price of $120,000. Then we add direct external cost of $6,000. Then we add the 2026 premium of $18,000 and the 2027 premium of $18,000. The total carrying amount is $162,000. The reconciliation is 120,000 plus 6,000 plus 18,000 plus 18,000, which equals $162,000. Nothing is expensed during the holding period under this method. In 2028, the policy proceeds arrive. Commerce Harbor Fund receives $240,000 from the insurer. The carrying amount is $162,000, so the gain is $78,000. The journal entry is complete and balanced. Debit cash for $240,000, credit investment in life settlement contract for $162,000, and credit gain on settlement for $78,000. Total debits are $240,000 and total credits are also $240,000. Now we add the impairment layer. Under the investment method, the entity does not simply ignore changes in recoverability. If new information suggests the insured may live significantly longer than expected, or if the insurer's credit standing deteriorates, the entity must assess recoverability. The test considers whether expected proceeds will recover the carrying amount plus future premiums and direct costs. If recovery is not expected, the investment is written down to fair value and the write down is recognized in income. Under the fair value method, a separate impairment test is not needed because fair value remeasurement already captures value declines. Now choose your answer. An investor acquires a life settlement contract in 2026 and elects the investment method. During 2026 and 2027, the investor pays annual premiums needed to keep the policy in force. Under the investment method, should those premiums be expensed immediately, capitalized as part of the investment, recorded as fair value losses, or treated as gains each period? Think through the method logic and lock your answer before moving to the explanation. The correct answer is B. Under the investment method, premiums needed to keep the policy in force are capitalized and added to the carrying amount of the investment. Option A is wrong because immediate expensing contradicts the cost accumulation model. Option C is wrong because fair value losses belong to the fair value method, not the investment method. Option D is wrong because no gain is recognized during the holding period. The gain waits until policy proceeds are received at settlement. Now write your response in your own words. The question asks you to explain the main difference between the investment method and the fair value method for a life settlement contract under ASC 325-30. A strong answer should cover four things: how the method election is made, how the investment is measured after acquisition, when income is recognized, and what drives the income amount under each method. This is a good written response question because it tests understanding, not just memory. Here is the model answer. The investor elects either the investment method or the fair value method at acquisition, and that election is irrevocable. Under the investment method, the carrying amount includes transaction price, direct external costs, and subsequent premiums that are capitalized during the holding period. No gain is recognized until settlement when policy proceeds are received and compared with the carrying amount. Under the fair value method, the investment is recorded initially at transaction price and remeasured to fair value each reporting period, with changes recognized in current period net income. If this lesson helped you, please like the video, subscribe to the channel, support the course, and share it with colleagues who are learning US GAAP. In the next video, we move to ASC 325-40 and study beneficial interests in securitized financial assets.